Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 55. And we're going to continue on understanding what creative financing really is through really going through the basics. And today, I'm going to leverage a very basic income and expense sheet and a very high level income property deal analysis process to really show you where every single number sits. And also, coming back from the previous episode where there was an impromptu deal analysis on a suited property opportunity right here in my home market, and that is Edmonton, Alberta, right here in Canada, we'll continue to do some more thought process on the deal analysis portion. Again, thank you for providing the opportunity. And at the same time, though, I haven't gotten more information yet. So I'm just going to go with what I've gathered so far. And because some of you actually did reach out and said you would like to see more and for me to continue the process. So I will definitely do that with you. And I'm guessing the reason why I haven't heard back yet is probably because you are doing your due diligence as I suggested yesterday. So I appreciate that. And so first thing first, I am going to continue on, as I mentioned, and bring up our little slides here so that you are able to actually visualize this for yourself too. I mean, I don't know about you. I find that in terms of adult learning and adult education, we need to see and hear at the same time to actually learn these days and to retain more. And this is also why I've always kind of relied on my flip charts too, still to illustrate points. And for people that have actually worked with me on mentorships or any sort of business coaching, you know that I've always got a notepad with me and with my pen and paper ready to go. And if not, I'll borrow a pen at a Starbucks. I will grab a ton of napkins and just start doodling away. So with that said, coming back here, if you can actually recognize this, remember, this was the basic business financials that we were calculating. And at the same time, because we are using real estate as our main asset class, we are definitely breaking it down to the formula that now you should be relatively familiar with. So revenue minus expenses equals NOI, and then we take out debt servicing equals our cash flow. Once we got our cash flow, depending on the number of units that you are actually thinking about getting, then obviously total cash flow on a monthly basis divided by the number of units, then you get cash flow per unit. Now, if you've actually watched season 2, where there was a few strategy sessions that happened, you understand how important this number is. And this number actually can be relatively arbitrary in the sense that you really do get to control how much net cash flow you would like to get per unit from your portfolio, okay? And I want to put a giant asterisk on that. This means post-stabilization number, okay? This is post-stabilization, means it is not initial number. I remember when I first got trained, and the trainer that trained me did not actually clarify this. And it turns out that the person that was training was actually not an active investor anymore. And so the funny thing is, a lot of us actually, we were kind of looking at deals going, oh my God, none of these deals actually fit the criteria. Turns out these numbers actually needs to be post-stabilization. And so again, if you have actually seen the strategy session episodes from season 2, and I'm going to post that in the comments section, vitally crucial. Why? Because that effectively allows you to create your personal roadmap and how you want to get to your financial independence and your financial freedom. Okay, for many of you, that's a 2 to 5 year process. Some of you might be shorter, some of you might be longer. It doesn't matter, because it all comes down to, again, it's not a one size fits all. And this is why Treasure Talent is here to help you tailor your roadmap. Because so many people like to kind of look at each other and go, I'm comparing myself to their progress. However, again, let's say if you are married, have a high pressure job with 3 kids, maybe even 4 children, it is really difficult for you to compare yourself to somebody maybe a little bit younger than you, have a bit more physical energy, maybe and they don't have children yet, so that they have a bit more time to dedicate towards things. And so this is why I always say, honor your own journey and start this journey by working with a strategy coach so that you get your roadmap done for you. And then the rest of it is just you honoring your own commitment to create the financial results that you want to create. So coming back here, I know that was a big tangent, and yet it really isn't so much of a tangent, because these days when we're doing a strategy session, especially when it comes to, let's say, leveraging income properties, multifamily as one of the strategies to build our income streams, we tend to say that post-stabilization, we put in $150 per door per month. Now, depending on your personal resources and also whether or not you need to bring in joint ventures or you need to borrow money and how much you leverage, again, this is all coming out now, okay? It's all in the debt servicing part. It determines how fast or how steady you run. I will never say slow, okay? Steady versus fast. Remember, I always say focus on the momentum. Focus on the momentum, not the speed. I've seen way too many people, they run way too fast without financial education. All they're doing is accumulating properties. In the last few years, that was okay. I'm going to bet you my bottom dollars right now. In July 2023, so many people that acquire for the sake of buying properties the last 3 years now are hurting, which is bad and also good in a way. Why? Unfortunately, this is where we actually get to come in and help them out, meaning now they've become motivated. They've become motivated and distressed sellers to a certain degree. And so the funny thing is I've now seen Treasure Talent trained investors buying up and acquiring properties from the lesser trained investors too. And so again, there's always two sides of a coin. And remember, it is not taking advantage of people. It's about coming up with win-win solutions, and you're helping people solve their real estate problems. And so coming back here now, here are some mental prompts for you. Remember, once again, if you're running this like a business, you need to make sure that there are enough income streams to form your entire revenue bucket, and you got to learn how to manage all your expenses. I already talked about this a couple of episodes ago. How you do anything is literally how you do everything. If your personal budgets are out of whack and you spend money like there's no constraint and you don't understand how it shows up on your financials, make sure you go back and read the first article that I posted on Medium, okay? I've also tagged that in some of the previous episodes, so I know if you're actually watching every single episode, you will come across one of those, and you will be able to follow the thread in the comments back to downloading it. I understand, because this summer now, some of you are actually watching this much later on, and you're not watching this live, and this is also one of the reasons why I know you're still engaged, because I am getting messages from a lot of you guys going, I am just catching up. There's a lot happening with summer programs, with the kids, with travels and everything. I totally understand that. However, I'm speaking to you real time right now. And so I just want to remind you, some of you, if you actually missed a few episodes, make sure you actually stop here and go back and rewatch the old ones first, or not old ones so much, the previous episodes and everything that I've tagged in terms of the older episodes from the previous seasons and the articles that I've written, so that you actually get a more well-rounded view in terms of everything that we are discussing here, okay? And so next, going down to cash flow, can it drop to zero? Well, again, remember, NOI is where it all starts. And so depending on how you negotiate on your debt servicing, these days, a lot of amateurs, their cash flow is now eaten up and going into the negatives because they did not understand how to leverage non-traditional financing. And so the moment the rates continue to go up over the last year and a half now in North America, they are now suffering and in the negatives and hoping, praying and hoping to write it out. So really, it gives the whole buy, rent, and pray a different perspectives now. This is not new. I just want to remind everybody of this. And you can see that between season 1, season 2, and now season 3, my tone has changed simply because I've gotten a bit more direct with everybody as well, and especially with my students and the people in the Trusted Talent community, because I understand that being nice doesn't help you get results. I want to be straight with you and I want to be real with you. And it's not to say that I don't like you, it's to say that I really want to help you grow by at least, at the very minimum, protecting your portfolio first and foremost. And so that starts with really emphasizing on the fact that there are certain things that you just don't do, okay? And so coming back down, you got to remember, can the cash flow drop down to 0? Abso-freaking-lutely. And expenses won't drop to 0. Let's put it that way. Can revenue drop to 0? Absolutely as well. And so remember, the biggest lesson now is making sure that you can control your expenses. And on a side note, and you probably heard me talk about this for the last 2 seasons now as well, is the fact that I don't believe in a single course called property management, even for investors. It's about portfolio management or asset management, because when it comes to revenues, largely it starts with the tenant screening process and the acquisition process to identify different revenue streams and the different income streams that contributes into the revenue bucket. And then when it comes to expenses, it is really more often than not managing the hard asset itself, which is the real estate portion. So when people can understand how separated these two factors, okay, these two factors are, then it becomes a lot easier for us to really create the strongest net operating income on every single property possible. And so continuing on, purchase price, a down payment, credit, everything else will affect everything. Every single one of these factors can affect your debt servicing and as a result, your cash flow. And I know a lot of you guys are rewatching some of these episodes. Congratulations, that's exactly what I want you to do. And I have no problem if you would like to take pictures or just make really good notes. In fact, I would actually encourage you to make really good notes, because when you just take pictures, more often than not, most people don't go back to look at them. First of all, this is just based on experience. And I don't mean to be flipping with you. I really just mean that I'm seeing so many people hurting these days, And I just want to make sure that you don't become one of those people, okay? And it sucks because I've been those people. And once in a while, I am still one of those people. Why? Because at some point, I let my emotions get in the way. I let my ego get in the way. I let my feelings get in the way. And remember, do not manipulate your numbers. And once in a while, I understand the temptation. And this is why everything that I'm sharing with you comes from also personal experience, because I can relate so much still, regardless of how many years and how many more years I've had maybe ahead of you in terms of my investing journey right now. And so next is interest rate amortization and potentially other factors, meaning how you structure your debt servicing, okay? And so at the end of the day, really what we want to focus on are equity and performance-based financing methods. What does that mean? Well, stick with me, and that's something that I will go into starting the next episodes. What I really do want to do now, though, is to really bring you back to the deal analysis that we started. And because some of you messaged me and said, hey, Tim, can you just keep going? I want to see, whether or not you think this deal is actually somewhat viable or viable at all. So based on the assumption here, first of all, because this is a property right here in Canada, I will use the Canadian mortgage calculator in terms of purchase, because this is also still what we would consider a small purchase and single family purchase rather. So let's start with this. Again, when you go into the income property course or the distressed property course with Trust Your Talent, you're going to get different spreadsheets and extensive analyzers as your tools. However, right now, once again, I could be doing this at a Starbucks, at a Tim Hortons. For those of you who don't know Tim Hortons, it's a Canadian brand for a coffee shop. And actually, Tim Hortons is making it pretty big now in the US and in the UK. So I don't know where else in the world they might be. I'm not quite sure if they're in the land down under right now or Asia, but hey, let's just say that this is more about the thought process, and whatever details that you find out, it all comes down to the business decisions that you will make based on your own personal risk tolerance. And so with that said, let's take a look at performance, okay? So in terms of revenue, right now, what we know is this. We know that the upper area, we have 1447 plus the 150, okay? And so what that means is 1447 plus 150, it is 1597, okay? Oops. 1597. Down, we know it's 1097 plus the 200. That's an easier math, so I'm just going to type it out like this right now. So total revenue, okay, in this particular case is 1297 plus the 1597 is 2894. Okay, now that you have 2894 as your total revenue, I know if you're actually doing any sort of due diligence yourself, you might find vacancy rates anywhere between 3 to 5% right now. I would always say, okay, if you're going to budget in vacancy here, I'm going to budget in at least 8%. Why? Again, based on stress testing your own deals, because there's also a lot of turnover expenses that most people don't account for. And more importantly, if you're hiring property management, most of you that want to come to this market these days are not based in Alberta or Edmonton. So this is something you definitely want to take into consideration. So what that means now is vacancy is 8%. So that means we realize 92%, okay? 92% of the total forecasted revenue. Now, I know some of you will go, hang on a second, you probably shouldn't include garage rental and utility fees. I'm just going to roll it all in, and you are right. You could be right in this particular case. But remember, in the previous episode, I also did mention that garage rental may be a separate lease altogether. So right now, I'm going to do a broad stroke. I want to make it very clear. I'm just going to do a broad stroke right now so that you can see the thought process here. And I'm pointing out all the subtle nuances for you as well as I go, so you can make your own decision on how you want to include the numbers. However, this is more meant for everybody to sort of follow along so that you can see a high level of how we do quick deal analysis on napkins at a coffee shop, between property viewings, between appointments, okay? And so it's 2662.48. I'm going to take out the 0.48 cents. It's okay. I'm just going to underestimate my revenue as I always do. Okay, really technically I'll probably shrink it down to about 2,600, but in this particular case, if you also had a spreadsheet, it would probably go down to the pennies. And so from an expenses perspective, right off the bat, if you have management, okay, management, most of the times you're looking at about 10%. However, the other thing is you got to add service taxes, okay? Service and sales taxes on top of that. So if management is 10%, then what that means is 200, okay, $66.20. And you got to add sales tax. In our province right now, it's only 5%. So what I'll do is 266.2, okay, times 1.05, and that will get me 279.51. So I'm going to do 280 right there. And then repair and maintenance. So in the ad, it did say, or the realtor listing, it did say that it is kept in very mint condition. The current seller, previous owner, kept it in meticulous condition. And so Again, maybe you can do 5% right now. However, your inspection report will show you how much more, or maybe even how much less. I would probably not go less, period. 5% is likely your minimum right here, okay? So 5% of your revenue, okay, likely is 266.2 divided by half, so it's 133.1. I'm literally doing this live right now with you, haven't really prepped anything, as you can see. So snow removal and lawn. You can do seasonal care. What a lot of people will do is perhaps one of the tenants can do those duties and you can pay a discounted rate. So let's just say that you pay them $50 a month. And I want to share this with you one more time. I've mentioned this before in previous episodes and previous seasons. However, I will never, ever give them a break on the lease, okay? You will pay them. This will become a line item in your expenses because you never, ever want your revenue number to shrink because of special arrangements. You want to make sure that your revenue, at least from the rent portion, is always keeping up with fair market rent in whatever case, because this will help you when the time comes to go in and do a refinance when you need to, or down the road when you want to sell, okay? So let's say $50 on a monthly basis is what you say you will pay them, and they say, sure, I was going to do it anyway, so might as well. And the other side of all of this right now is, what else do you think you want to budget for? I mean, pest control is always one thing that we always say you want to do. Legal and accounting, maybe, depending on if you need joint venture partners and you want to keep the deal very clean. So each property has its own legal and accounting fees in the beginning and on an ongoing basis. Remember, if we're talking about performance right now, it's on an ongoing basis, okay? And so regardless, what I really want to bring it back here, because honestly though, this is really my style now and you can make your own business decision. I really don't feel good about budgeting repair and maintenance for 5% here, because if you take 5%, sorry, it should be 133, not 144, 133 a month, okay? 133.10 cents. Times 12 months. That gives you an annual budget of $1,597, okay? Now, I want you to think about it. Perhaps you are not cleaning your furnace every single year. However, if it's a legally suited property, you will now have 2 furnaces, and I don't know, maybe you can negotiate for the seller to clean the furnaces before you take possession, and that might actually leave a little room for you, maybe for 2 years, maybe for 3 years. Again, I don't know how clean, how dirty your tenants are. Obviously, it's recommended at the very least that you get it done every other year. And every single time you clean a furnace these days, you're looking at anywhere between $400 to $700, depending on who you go through. Now, a quick tip is most furnace cleaning companies and carpet cleaning companies, you can actually set up corporate accounts with them if you're a volume-based investor, okay? Which most of us should be if you're properly educated and you understand how to scale your portfolio. With that said, though, again, that is just one of the expenses. You need to make sure that you also have your gutters, your regular seasonal maintenances. Again, anytime there's any sort of issues, even if it comes to insurance claims, depending on your coverage, your deductible at the very minimum is $1,000, usually all the way up to $3,500 these days, depending on your coverage. So one little thing can actually throw the whole thing off. And even if there is just a simple toilet challenge and you need to get a plumber to go out and fix it, call out fees these days is easily $95 or more before they even diagnose anything, before even more labor and materials charge comes in. And this is why I always encourage people to actually over budget this as well. And so again, if you were me, I would do at the very least 10% or more, okay? So now you have it. Again, it's 266.2 right here. And so for pest control, anytime you need to call somebody out to clean anything, it is definitely in the 4 digits. However, again, fingers crossed, you don't want it to happen on a too regular basis. Regardless, I'm still going to do 5% here minimum. So it's the 133.1. And then legal and accounting, I'm not even going to talk about setup fees here. Every single year, from a legal standpoint, if it is a standalone corporation, you're looking at about $300 to $400 these days to do an annual resolution. And your accounting based on per corp or bookkeeping, even on a per property basis, you're probably looking at roughly about $1,000. So all in all, you're probably going to be budgeting at the very least 150, depending on how you structure your corporations. As said, at the very, very least, okay? By the way, what about property taxes? Okay, a property like this, I actually didn't see the whole listing here, but given the area, I'm going to guess on a monthly basis, it's at least $300. And from an insurance perspective, you're probably going to be budgeting at about $160. So right off the bat, total expenses, I want you to add it all up now. Okay, so 280 plus 266.2 plus 50 plus 133.1 plus 150 plus 300 plus 160, you are right now sitting at about 1340.2. And then we now have an NOI of 1321.8, 1321.8. And now we're going to do debt servicing. Okay, debt servicing, what I'm going to now assume is that you are able to qualify for just 20% down payment, which means 80% loan to value. And I'm going to assume that you have a decent credit score and you are able to carry the whole thing well, so that you are now able to get a locked in rate at, let's say, 6.35% and 3-year term. You don't want to lock yourself in for too long, just in case the rates are dropping or if it's going up. Regardless, you want to give yourself some sort of flexibility if you don't want to go into variable, okay? And then you can do 30-year amortization. So on that note, let's take out our purchase calculator or the Canadian mortgage app. As you know, let's say purchase price, as we mentioned in the previous episode when we first started, I don't know the comps right now, okay? I'm just going to assume that you actually buy this property at exactly asking right now, okay? So that there's no confusion here in terms of how we run the numbers. So 389,400. 389,400. Down payment is 20%. Rate is at 6.35. Okay. Now, if you actually can qualify for better, great. At the same time, though, I'm just going to do 6.35 at the moment. So amortization, 30 years. So what that means now is on a monthly basis, your PI or mortgage payment, which is our debt servicing, is 1921.65. 1921.65. Well, now guess what? After all is said and done, you are now looking at a negative cash flow of 599.85 on a monthly basis. So is this a deal that I would do right off the bat? No. I would say that if this number came in at about minus 50 on a monthly basis, there might be wiggle room, because the point is not to break even, as you know. The point is to create a healthy cash flow for you. I mean, 50 bucks positive, 100 bucks positive, whatever your eventual business decision is, because this is 2 doors based on the numbers that I generally use these days of $150 per door per month post stabilization. This should be cash flowing at about $300 on a monthly basis. And so what that means is now you actually have a delta or a difference, a gap of 600 bucks in the negatives all the way to plus 300. That's $900. That is going to be very, very difficult to find unless you're able to drastically improve the performance when it comes to revenue and drastically reduce your expenses. And frankly, at the moment, I don't see how, because there's also the question of, are utilities paid by you as the potential new buyer? Okay, so again, this is where the investor mindset is so important and what we keep on emphasizing on. And I know I'm half an hour in already today. However, this is so important. Investors, we don't focus on how much it's going to cost us. Okay. An investor focus on how much it's going to make me, not how much it's going to cost me. I know so many people from other provinces are now coming into Edmonton simply because, oh my goodness, I can buy a property for less than $390,000. That's basically my down payment in the Toronto area, in the Vancouver area. And you know what? Minus 600, that's not a big deal whatsoever. And then you're going to see that number grow the moment these expenses are out of whack and that servicing potentially is out of your control. And so this is not why we learn how to invest, because you're basically banking on the fact that maybe this is going to increase. And even if it does, I want to bring you guys to go back and watch some of the earlier episodes in this season where I actually did that comparison. I don't exactly remember which episodes now. However, I'm going to grab them and post them in the comments section again. And so at this point, I would say deal or no deal. This is definitely a no deal for me regardless. $900 per month based on post-stabilization number is way too challenging to achieve at this point. So I would say no deal. And if you're doing the extra due diligence right now, make sure if you find out numbers that are more favorable to what I've put down here, feel free to share. And then I'm more than happy to review all of this process with everybody. Okay. So on that note, thank you for joining me again. I hope to see you tomorrow, Saturday, July 22nd at our next coffee chat, where many of the trainers, coaches, and mentors from the Trust Your Talent team will come and share with you what has contributed to their successes leveraging real estate investing to build their financial results. And so we're calling it the 3 key ingredients for succeeding in real estate investing. So with that said, enjoy the rest of your day. Live well, everybody.